Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Equinix Inc., ticker symbol EQIX. We're looking at Equinix today as a subscriber request. The business is one of the largest real estate investment trusts in the world. Over the last year, the business's stock price is up 6.5%, which is in contrast to the overall S&P 500 index, which is down over this period. Currently, Equinix is trading for $716.76 per share. Over the last 5 years, the business's stock price is compounding at a rate of 12.5% annually. Over 10 years, they're compounding at a rate of about 13% annually. And going back prior to the global financial crisis, over the last nearly 18 years, Equinix is compounding at a rate of 17% annually. This is far outpacing the performance of the S&P 500 over this period. And in addition to their returns and their stock price, Equinix is a real estate investment trust, so they have to pay out 90% of their earnings as dividends to shareholders. Currently, the business is paying out a 1.7% dividend yield, and so their average dividend yield throughout this time frame would be in addition to this compounded annual return. Equinix originally went public during the dot-com bubble. It had a soaring valuation of more than $460 per share in its first year of trading. However, the business had one of the sharpest declines of any company that ended up making it out of the dot-com bubble. They fell to a low of just $3 per share in 2003. And since then, the business's stock price has increased more than 200 times. So currently, Equinix is trading $60 below their 52-week high. They're more than $200 above their 52-week low. Right now, there's not a lot of short interest around the business. And Equinix, again, is one of the largest real estate investment trusts. Currently, they have a $66 billion market cap. So for additional background about the business, Equinix is a retail provider of data centers, enabling hundreds of enterprise tenants to house their servers and their networking equipment in a co-located environment. Tenants can then connect with each other, cloud service providers, and telecom networks. Equinix operates 240 data centers in 66 markets worldwide and owns just less than half of them. The firm has roughly 10,000 customers, including 2,000 networks that are dispersed over 5 verticals: cloud and IT services, content providers, network and mobile services, financial services, and enterprise. About 70% of Equinix's revenues come from renting space to tenants and related services, and more than 15% comes from connecting customers with each other. As mentioned, Equinix operates as a real estate investment trust. So for our fundamental analysis today, we are going to be performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Equinix based off of their business fundamentals. This analysis is still a work in progress, and it's an opportunity to learn in public, so we're going to be modifying it slightly compared to what we would do for a typical business in order for this to better fit a REIT. And this is still an evolving process, so it's going to improve and get better over time. So with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on equity over the last 5 years to be above 14%. If this is the case, this will potentially offer us a margin of safety in the business by having their returns on equity be about twice as good as those of a typical business. It's been the case that Equinix has earned below average returns on equity in all 5 of these previous fiscal years. In their most recent fiscal year, the business earned 6.3% return on equity. And while that is up from where the company was at during their lows in 2020 over this period, this is still below the average returns on equity that a typical business is making. Over this time frame, Equinix is only earning a 5% average return on equity, and so this is going to be an X here on metric number 1, as again, these returns are below average. Next up, for metric number 2, we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and cash from operations growth over the last 5 years for a REIT. This metric will be all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. So over this time frame, Equinix's revenues have increased by 42%, their earnings have almost doubled, and their cash from operations have increased by 63%. This is strong growth here across the board for the business, so this will be our first check of the day coming in here on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Equinix on a per share basis. So we're looking for earnings per share growth over the last 5 years for the business. So we learned in our previous metric that their earnings have almost doubled over this time frame. So we also want to look at what they've done in terms of their shares outstanding. Over the last 5 years, Equinix has diluted existing shareholders by about 14.5%. So far, this has not been that uncommon when we've analyzed REITs. It's often the case that REITs will make acquisitions to fuel their growth. and because they're buying typically asset-heavy businesses. From the other REITs that we've looked at so far, it's been the case that many of their acquisitions are paid for with some combination of their cash and their shares. That potentially looks like it's the case here for Equinix as well. We ideally don't like to see this because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. And so when a business dilutes existing shareholders by issuing new shares, they're decreasing your ownership percentage in the business, which will ultimately decrease the percentage of the business's profits that you're entitled to. In this case for Equinix, even though they've grown their earnings over this time frame, your percentage of those overall earnings is slightly down as a shareholder. However, their earnings have grown on a per share basis, and so this is going to be a check here on metric number 3. While again, it's less likely for there to be huge mistakes here by issuing shares for their acquisitions because they're buying more or less hard assets. Some of the worst investing mistakes that Warren Buffett has ever made in his career have come from when he's issued shares to make acquisitions instead of just paying for those businesses in cash. That really comes down to the fact that mistakes can continue compounding if you give away your shares in order to pay for an acquisition, whereas laying out cash will only be a one-time expense, and barring some sort of legal repercussion or some liability from the business, that's the maximum amount of money that you're likely to lose from that transaction. Again here, this is a check on metric number 3. Next up for metric number 4, here we're looking for something similar. So here we're looking for free cash flow per share growth for Equinix over their past 5 years. So Equinix has steadily grown their cash flows per share in all 5 of these years. In their most recent fiscal year, the business produced $32.36 worth of free cash flow for each share that they've had outstanding. And so their strong cash flow growth again outpaces their shareholder dilution. This is another check here on metric number 4. And so far through our first 4 metrics, we have 3 checks and only 1 X for Equinix. Next up for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. We want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of cash from operations that the business has produced over their last 5 years. So Equinix has steadily added on to their net debt position over this time frame. The business ended their most recent fiscal year with $14.5 billion worth of net debt, and over this time frame, Equinix has only produced $11.6 billion worth of cash from operations, meaning that compared to their historical cash from operations, it looks like the business is utilizing more leverage than we're necessarily comfortable with. So this is going to be an X on metric number 5. There are some caveats we want to be mindful of here. One is that Equinix, again, is dealing with physical assets for the most part. And so it's often the case that these real estate assets are able to be more highly levered than the assets employed in some other types of businesses. Also, with their steady acquisitions that the business has made over these past 5 years, and with the type of business that Equinix operates in, it's likely that their cash from operations are pretty steady in most years for the business. And it would seem to be the case that it would be unlikely that their cash from operations would really regress from the levels that they're at. Again, though, this is just a snapshot of their past 5 years of performance, and that's not necessarily a guarantee for the future. If we were to extrapolate their current cash from operations out over their next 5 fiscal years, that would mean the company would be producing about $15 billion worth of cash from operations over that time frame. And so it does look like from their current cash from operations that the business would be able to support their debt loads. So that's just something you'd want to be aware of as well. If you're potentially concerned about the company's debt loads, you would just want to dig into their filings and learn about those in more detail. The company will break out how this debt is structured, when it matures, and what rates it's at. And again, you can read about that in the business's filings. Then for our 6th and final metric, the big metric of them all, we want their average cash from operations over their last 5 years to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially offer us a slight risk premium to the yield of the 10-year treasury and potentially offer us a reasonable starting point for evaluation of Equinix. So currently the business has about an $81 billion total enterprise value, and we're using their enterprise value because it takes into account both the business's market cap and their net debt position, and it's going to offer us a perspective of the business that's more similar to as if Equinix were a private company. We learned over the last 5 years that the business has produced $11.6 billion worth of cash from operations over their previous 5 years, meaning that in an average year, the business earns about $2.3 billion of cash from operations. So when we divide their $2.3 billion of their average cash from operations by their $81 billion total enterprise value, that is only going to give us a 2.8% average cash from operations to enterprise value yield for the company. This is coming in slightly above half of that risk premium we're ideally looking for, but this is solidly below the yield of the 10-year treasury, and so this is going to be an X here on metric number 6 for Equinix. as it doesn't look like the business is offering us that risk premium that we're ideally seeking. When we look at their cash from operations from their most recent fiscal year, the company has produced about $3 billion worth of cash from operations. So to get a current cash from operations to enterprise value yield for the business, when we divide their $3 billion of their last 12 months of cash from operations by their $81 billion total enterprise value, that is going to give us about a 3.6% current cash from operations to enterprise value yield for the business. So that's right about in line with the yield of the 10-year treasury. Again, though, that would be below the risk premium that we'd ideally be seeking here. So just because this is an X here on metric number 6 doesn't mean that you're necessarily going to throw this business out in its entirety. This is just one of our 6 metrics, and these metrics are meant to be taken in holistically. While they are simple, when they're combined together, they can be very powerful. And not to mention, we've still got some interesting aspects of the business left to cover. So then as a bonus, here we're taking a look at Equinix's dividend profile. So Equinix currently pays out a 1.7% dividend yield. Because the business is a real estate investment trust or a REIT, the business has to pay out 90% of their earnings to shareholders as dividends. To get a perspective of the cash flows of the business in comparison to their dividend yield, we want to look to see that the business's cash flows are able to healthily support the company's dividend payouts. And that's been the case in all 5 of these previous fiscal years. In all 5 of these years, not only has Equinix steadily increased their dividend payouts per share, even with their shareholder dilution, they've also steadily grown their cash flows per share in all 5 of these years as well. And it would seem like from their past 5 years of their performance that the business would be very healthily and very easily able to support their dividends sustainably into the future. Even though this is the case, again, be mindful that the past is not necessarily an accurate predictor of future performance. Then everything we've covered so far is important, but there's something missing that in my opinion is the main reason to analyze Equinix, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Equinix. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. Here we're starting with the company's current free cash flows per share and using historical growth assumptions in order to give us a baseline projected estimate for the business going forward. So if we assume that the business can grow their free cash flows at a rate of about 7% annually over the next 10 years, which is based off the historical growth rate the company has grown their cash flows at since becoming a publicly listed business back during the dot-com bubble, then if we assume that that growth rate is almost cut in half and the business only grows their cash flows at a rate of 4% annually for the 10 years out after that, so it's up to you to do your own homework here to determine whether or not these historical growth assumptions are going to be accurate and applicable going forward to give a baseline projected estimate for Equinix over their next 20 years. Using those growth assumptions and then adding in the company's tangible book value, which gives us an approximation of the business's tangible net worth per share. If we were ideally seeking a 15% rate of return from Equinix, which is the rate of return that Warren Buffett is ideally looking for from his investments, in addition to his margin of safety requirements, which will depend on the dynamics of the industry that a business operates in, as well as how that business compares to its competitors, then it looks like from today's valuations of the business that a fair value for Equinix is only $362 per share. That's down quite significantly from their current stock price. That's only about half of their current stock price, and that would be about $140 above the business's 52-week lows. So please keep in mind some caveats here as well. We would not be doubly counting their dividends, so this 15% rate of return would be including their 1.7% dividend yield. Also, there are reasons, again, why this may not be accurate for the business, and a discounted cash flow model is ultimately based off the overall predictability of a business's future free cash flows. While Equinix does operate in an industry and is a type of business that tends to have more predictable free cash flows than the typical business, and that has seemingly been the case in the past for the business, there are reasons why that may not be potentially the case for the business into the future. And so you would really want to dig in and understand, again, both this company and the industry that they operate in more detail. That can better inform some of the assumptions that you would put into this model. So please be mindful of the fact that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our summary for Equinix, but we have to address something first. What are some of the qualitative aspects of this business, especially those that support either a potential long or a potential short thesis of the company? So starting with some of the key points around a potential long thesis for the business. Number one, Equinix's deep global global footprint makes it more attractive and stickier for customers and allows Equinix to offer new products and capabilities that provide an even bigger barrier compared to competitors. Number 2, among data center companies, Equinix is the biggest beneficiary of a continuing shift toward cloud usage, as Equinix has far and away the most cloud on-ramps. And number 3, the Internet of Things, artificial intelligence, and other innovations that increase public demand for data and connectivity require more hardware and connections in Equinix's highly connected data centers. Then for some of the key points around a potential short thesis of the company. Number 1, technological advances will allow aggregate data needs to be met with less physical space and power and fewer direct connections, reducing their data center needs. Number 2, a greater move by businesses to infrastructure as a service platforms and virtualization will reduce individual companies' needs for their own spaces in Equinix's data centers, preventing Equinix from being such a big beneficiary of the secular trend toward more data use. And number 3, Equinix is too dependent on cloud service providers, leaving the company at the mercy of these companies over the long term. So hopefully that offers a potentially balanced perspective around some of the key qualitative aspects of the business. Now it's time for our wrap up. So in summary, Equinix checks the box on 3 out of our 6 metrics today. The business has strongly grown their revenues, earnings, and their cash from operations over their last 5 years. Even though they've diluted existing shareholders by 14.5% here, they're still growing on a per-share basis. However, they've achieved this growth by earning below average returns on equity for their investors. And again, they've both been issuing shares and taking on more debt over this time frame. Even though it looks like the company's historical cash from operations would not be able to support their debt loads, it does look like the business's current cash from operations would be able to. And again, because we're dealing with data centers and real estate assets here, these assets are likely able to take on more leverage than other types of assets owned by different businesses. When we compare the business's average and their current cash from operations to their enterprise value, it does not look like that would be giving us a sufficient risk premium in comparison to the yield of the 10-year treasury. Looking at the business's dividend profile, it does look like their dividend is healthily supported, as the business has steadily and stably grown their free cash flows in each of the past 5 fiscal years, and they've grown their dividend payouts per share as well. Finally, performing a discounted cash flow analysis of Equinix. If you've done the work and you believe that those historical growth assumptions are going to be accurate and applicable going forward for the business, and you were ideally seeking a 15% rate of return from the company, then it looks like at today's valuations that a potential fair intrinsic value for Equinix is only around $360 per share. That would be less than half of the business's current stock price. Again, it's worth doing your own digging into the company because there are reasons why those assumptions may not be accurate, so it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Equinix. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to research a business as if you're going to own 100% of it, and you can truly understand the ins and outs of that company, learning about the business accurately, completely, and then going back and asking yourself, what did you miss, in order to come to the underlying essence of the business and understand what's going to matter and what's not going to matter for the business going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Equinix, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Equinix Inc., ticker symbol EQIX. Again, we looked at the business both as a subscriber request and because this is one of the largest real estate investment trusts. I want to continue to improve how we analyze REITs, and so I'm glad to make a video on the company. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what company you want me to take a look at next time. Thanks for learning about Equinix with me, and have a great day.